Okay, picking up with CGL Part 2, last lecture spent most of the time talking about limits and how to apply them. That's critical stuff. You're going to want to make sure you know how to do that. Let's go ahead and talk about some of the conditions here. So here's a list of them. I'm going to just pick some out that I want to talk about. So the first one, the bankruptcy condition. This one's actually pretty straightforward. It just says that if I'm the company that bought insurance and I go bankrupt, that doesn't mean that the insurance company is off the hook for defending me if there's a liability lawsuit, or that they're off the hook and they won't have to pay. Just because I go bankrupt, they're still going to have to defend me. And they spell that out in the condition, in the conditions to show that, yeah, just because you go bankrupt, that doesn't mean that your obligation of your insurance company will end. So that's a simple, straightforward one. And it's probably not one that, ordinarily would come up very often or that anybody would expect, but it's listed. So we'll go ahead and mention that briefly. Next one that I want to talk about is the duties that you have in the event of a loss. So they can be basically summed up by saying notify and cooperate. So you have to notify the insurer that you're aware that a lawsuit is going to be filed against you. You might get papers served on you. And when that happens, you got to send that over to the insurance company with reasonable speed. That might be when the insurance company is investigating that they're going to need some records that require your permission for them to get. If that's the case, you have to agree to give that permission. That's part of cooperating. And then through the investigation, the claims process, they're going to need some time from you. They're going to need a statement, what happened, what's your take on what happened. As we move through the court process, they may need you to give a deposition or actually testify in court. That's kind of a hassle. There's no two ways around it. That's a tough thing. I mean, when you testify in court, maybe some of you sit in a room and you're not allowed to do anything. You're not allowed to have a cell phone with you. You have to sit and you have to wait to be called. And sometimes it happens, you're not allowed to participate and see what's going on in the court case. You're not allowed to be part of that. So you sit and you wait and eventually they call you. And sometimes you show up at 8 o'clock in the morning. Turns up they don't need you that day. It's frustrating. It's a hassle. You have to agree to do this if you want the insurance company to defend you. If there's any subrogation, so you've been sued, your insurance company is planning on paying, but somebody else is responsible. You have to agree to assist with the subrogation piece here too. And then finally, we say that voluntary payments, if you make any payment to anybody, we're not guaranteeing that the insurance company is going to reimburse you for that. So it might happen somebody sues you and says, hey, you're going to be liable. Why don't you go ahead and advance some money to me because I've been injured and I want to be able to pay some of my expenses. Sounds like a nice thing to do. But if you do that, the insurance company may or may not decide to reimburse you for that. And they just want you to know anything you do on your own, voluntarily giving money to people, is at your own risk. And so they're actually going to write that in the contract and say, hey, if you do that, all right, sounds like you're being a nice person. But we may later on decide that was not money that should have been paid. Remember, the insurance company isn't going to pay unless the insured has been shown to be liable. Without that, they're not going to pay. Here's another part. Nobody can sue your insurance company. That's not how this works. They sue you, and then the insurance company defends you. And then all those conditions are invoked and you have to notify, you have to cooperate. So it might sound like a smart idea. Well, I'm just going to sue your insurance company because they're the ones paying. Not how this works. You sue the corporation that you think is responsible, the entity that you think is responsible, and then their insurance company defends them. That has to be the direct way that we do that. There's no way to get around that by trying to sue the insurance company rather than the responsible party. And so they're just spelling that out in the contract saying, look, we want everybody to be clear on how this process actually works. Then we need to talk about other insurance. So the idea behind other insurance is, it is what it says. What if you have another insurance contract that also covers this loss? So you could have two insurance companies that are legally responsible for paying the loss. Well, they're not each going to pay. Right? You don't get paid twice. We're not going to pay some injured party twice. That creates huge moral hazard problems. So we have to figure out the liability. How do we divide that? And this is a review from 270. There's only 3 ways to do it, and none of them are really hard. So one way to do it is we say, let's look at the limit of insurance that each company provides. And then if you provide twice the insurance limit that the other insurer does, then when the loss comes in, you will pay 2/3 of the loss and they'll pay 1/3. So we can do it by comparing the limits of insurance we provide, and then whatever percentage of the total that one company provides, that's the percentage of the loss that they pay. There's a decent example in the book, and this is a fairly simple idea. So I don't want to make it more complicated than it sounds. Let's say insurance company A is providing $500,000 of insurance. Insurance company B is providing $1 million. Okay, well, the total is $1.5 million. 1/3 of it is provided by company A. 2/3 is provided by company B. So if there's a $300,000 loss, 1/3 of that, $100,000, is paid by company A. 2/3 of that is paid by company B. If the other insurance condition in the contract is pro rata, or we also call it contribution by limits, it's the same thing, then that's how that loss will be settled. We'll just take the percentage of the total coverage that each company provides. That's the percentage of the loss that they pay. Pretty simple and straightforward. And the good news is that's the hardest one. And it's not that hard. Equal shares, super easy. If we have other insurance and we've agreed that we'll handle losses on an equal shares basis, that means we share the losses equally. So if there's a $300,000 loss, we don't care what the limit of coverage each company provides is. Each company is going to pay $150,000. They're sharing the loss equally. If it's $1 million loss, we're each paying $500,000. The only wrinkle that can be thrown in there is if you have a loss that's above the limit. So let's say a $2 million loss. Well, company A provided $500,000 in insurance. They never have to pay more than their limit. And so that's how we handle that. We've got the same limitation with pro rata. No company ever pays more than their limit. And then the third way to do it is a real common way to do it. It's primary excess. And we stipulate in advance which company is the primary company. We use all of their limit first, and we only use the excess limit if we exceed the primary limit of coverage. So company A provides $500,000, company B provides $1 million. Let's say company A is primary and there's a $700,000 loss. Company A is going to exhaust its limit of $500,000. There's $200,000 left. That's what company B has to pay. That's excess. That's primary excess. And we'll stipulate in the contracts that we have with each insurance company how we handle other insurance. And that's a literal term. Do you have other insurance? If you do, we have to figure out how we're going to split the liability when losses happen. And primary excess is really common because we handle that on the front end. So every company knows, hey, we're providing the primary layer. And then the next company knows, hey, we've got the middle layer, and so on. If we don't agree on primary excess, if we've got both companies claiming that they want to be excess, then they get forced into pro rata. They get forced into contribution by limits if there's no agreement there, and that's the only way to handle that. So again, this is a review from 270. Also, there's a really good example in the book, but I do think they make that example a little bit more complicated than it has to be. It's not that hard. If it's pro rata, we're looking at the limits and we're saying what percentage of the total do you cover? Then that's the percentage of the loss that you pay. And that's not that difficult. A lot of times when you pay your premiums up front, we don't know what the actual result is going to be. So this happens across all kinds of different lines of insurance. We'll see it in workers' comp when we go to talk about that. Same idea. Here with liability coverage, if you're a retailer, for example, your rate that you pay on your premium is usually a rate per dollar of sales. And we're insuring you for the year to come. We don't know what your sales are going to be. So what happens is we have to have an audit process in place because we've charged you on the idea that you're going to have $2 million in sales. Well, we get to the end of the year and you really only had 1.9 million. That means you overpaid. You're due a refund. And it can go the other way too. We charged you based on 2 million in sales, had a great year. You got 2.5 million. You haven't paid enough for your liability coverage. We got to go back and reconcile. And so, yeah, we have a condition there that says you've got to show us records. And then later on, we come in and we audit. And if you paid too much, we'll give you a refund. And if you didn't pay enough, then you have to pay that to us to compensate for the prior year. And it's a fairly straightforward process. So if you're a retailer, your rate is going to be based on something that is currently unknown. What are your future sales going to be over the course of the year? If some of them are done by payroll, how much payroll do you have? That dictates your liability rate. A contractor, for example, would have CGL rates determined by payroll. We don't know your exact payroll. We're not going to know until we get to the end of the year. And so we're going to go through and we're going to audit. And again, if you've paid too much, we'll give you a refund. If you haven't paid enough, we'll go ahead and ask you to pay in the balance as part of that audit process. It's important to know that the things that you said in the declarations are treated as representations. And that means, remember, if we go all the way back to 270, insurance relies on the idea of utmost good faith. There's a lot that the insurance company doesn't know about your business. And so anything you volunteer, we're assuming that's true. And the penalty is this. The insurance company relied on those representations to set a rate. So if there's something that's false in those representations, then it's a misrepresentation. And if it is a material misrepresentation, that means it would have affected the rate or the coverage decision. That's material. It materially changes what the insurer would have done. If they rely on that representation, turns out to be a material misrepresentation, then that means they can void coverage even after there's been a loss. And sometimes this happens. So insurance company gets hit with a big claim. It's not uncommon for them to go back through the declarations and just double check, make sure everything's true. Because if they find something that's not true, and if it's material, if it would have changed what they would have done in terms of rates or whether or not they would have covered, then they can void coverage right then, retroactively. It's a controversial topic, but it's important to know that that's the insurance company's remedy. If there's a misrepresentation, they can get out of the contract entirely and they don't have to pay even after there's been a claim. So the lesson for the insured, don't lie. That's really, really not to your advantage. People think, well, if I misrepresent something, maybe I can save some money on your premium. What you're really doing is risking there being no coverage at all. Not worth it. That's just a doctrine you want to be aware of when we talk about representations in the policy. Okay, next up, want to talk about separation of insureds. All we're saying is that each individual person is protected by the policy. So it could be that somebody else does not have protection under the policy. That doesn't affect the first person that we're talking about. It sometimes happens that insureds sue other insureds. That can happen, and that's okay. That doesn't void the coverage. And this is the policy provision that talks about that. It doesn't increase limits. Limits still apply. But it is possible for one insured to sue another. That's not unheard of. Like in all insurance contracts, if they're going to cover your loss, you have to assign the right for them to try to subrogate. And you're going to have to help if you want to do that. They're also, as non-renewal is included in this clause, and they're going to say, if we're not going to renew your policy, we'll give you 30 days notice. So at least you know, at least you have time to shop around and find another insurance company for your CGL. So there is a limitation in the policy on the insurance company's right to non-renew. And yeah, any subrogation that they do, if they're going to try to recover against a third party, you're also agreeing to help with that. That's part of the notify and cooperate pieces of the conditions. So we're just underlining that here with this provision saying, hey, you still got to do that. Okay, up until now, we've really been talking about occurrence-based CGL, and that's the most common type that's out there. It is possible to write the exact same policy. It will be identical. The only thing that's going to be different is the trigger. Whether it's an occurrence, whether we're talking about this as a claim that has to have occurred during the policy period, or if it also has to require that the claim is made within the policy period. And so that's what we talk about with a claims made trigger. Where does the claim have to be made to be able to trigger coverage? Sometimes when we write these policies, we include a retroactive date that goes back earlier. The book makes this a lot more complicated than it has to be. This is kind of a simple idea too. So the retroactive date, a lot of times it's the date the policy is written, in which case it's not going to change anything about whether or not something's covered. Either it's not going to cover a claim that's made before the policy was written. Sometimes when you're switching from occurrence to claims made to help cover the gap, they will include a retroactive date that is earlier than the start of the policy. And then they're saying, all right, as long as there's a claim made before that date, after that date, then we're okay. The real problem is at the end, right? So if a claim hasn't been made, if we don't change anything about the policy expires, claim hasn't been made, then coverage ceases. You can imagine, all right, especially like we're in the end of the year, it's December, and on December 31st, we might not be aware of claims that are going to be filed for something that happened on December 15th. That's only 2 weeks. It would be real easy for somebody to file a claim based on something that happened on December 15th and not file for 6 months or a year or a long time. If you stay with the same insurer on a claims made basis, it doesn't matter. That isn't going to change anything. It's when you switch that can cause problems. So if you're going to switch, you might want to think about adding what we call an extended reporting period. And these can be long. They can go up to 5 years, where you say that, yep, coverage ended on December 31st of 2020. But we're going to have an extended reporting period to cover any losses that happened during that policy period in the year 2020. As long as the claim is made by as late as 2025, it can still be covered. That's an endorsement. It's going to cost you extra. But if you're switching from claims made to occurrence, that's something that you really have to watch, right? Because your claims made coverage ends 12/31/2020. Your occurrence policy picks up 1/1/2021. What about the stuff that happened in December 2020 that wasn't reported until 2021? Well, it's not covered under the claims made policy because that cut off on December 31st, not covered under the occurrence policy because that didn't start till January 1st. This extended reporting period helps cover the gap. That's the idea. There's all kinds of endorsements, hundreds of endorsements that you can use to alter the coverage here. Some of the more common ones, you could exclude coverage B. You could say, look, our business doesn't rely on advertising. There's not going to be any personal injury or advertising injury. We don't need that coverage. Okay, endorse it out, exclude it, and then you'll end up with a lower premium. Maybe there's certain employees we don't need to cover. We can endorse and exclude those. Some of our products that we make, we might want to insure separately or not insure at all. You can endorse those out of the CGL. Pollution is included, but it's only a little bit of coverage. You can get rid of it altogether. Pollution coverage, maybe your business has nothing to do with pollution. And you could exclude that altogether with an endorsement as well. Next up, wanted to talk briefly about certificates of insurance. It's really common when you're working with somebody, doing business with somebody, that they will require you to prove that you have liability coverage. So I'm building a building for the school district. They are going to insist that I prove to them that I have liability coverage because they've got liability from the premises. So they want to make sure that as their contractor, I've got coverage in place. And they do that by asking for a certificate of an insurance. And that is something you have to contact your insurance company and ask them to provide, because sometimes these groups will insist on also being named as an additional insured, and that doesn't just automatically happen. You have to endorse that in. So whenever somebody asks you for a certificate of insurance, you need to forward that request to the insurance company. It's a common thing, happens all the time. They know how to handle it, but they need to know. It's not good enough for you just to go back and say, oh yeah, I've got liability coverage, don't worry about it. Or to sign something stating that you do. You need the insurance company to certify that. That's the whole point. And a certificate of insurance is a one-page document that works real simply to show that, yeah, of course, we're going to cover somebody else who's related to you. Remember, in the definition of the insured, that was one of the things that we say. If you're working with some other organization, they are an additional insured. It's just that to specifically name them, you need an endorsement. And that's usually what that outside organization is going to insist upon. So the big lesson, somebody asks for a certificate of insurance, get your insurance company involved, because sometimes that process is a little bit formal than you might think, although it is fairly straightforward and easy. As far as rates and how we pay for coverage, how do we figure out what your premium ought to be? Well, it depends on how we're going to measure that in terms of risk. So how do we figure risk? Well, for a retailer, the exposure is sales, how big you are. And a proxy of size is sales. And the more sales that you have, the more exposure that you've got. We have in the commercial lines manual, we have 1,000+ different types of operations with different rates. Each operation has a class code, and from there we're looking at premises and operations. And then we also have products and completed operations. Remember, these are going to be separate limits, separately calculated premiums, and they'll list those two pieces separately on the declarations page too. So we're going to go ahead and describe it. All right, you're a clothing retailer. All right, well, we've been in business a long time. We know a little bit about the exposures of a clothing retailer. And it's one thing to be a retailer that has $1 million in sales, and it's another to be a retailer that has $50 million in sales. And so we might just use sales as the base on which we're going to apply a rate. And that's what tells us what our exposure is. That's how we calculate your rate. And then, of course, if it's sales, at the end of the year, we got to go back through and we're going to have to audit that. To make sure that the figure was accurate. So retailers, sales, that's how it works. Contractors, it's payroll. Apartment complexes, number of units. If you need liability insurance for a special event, how many people are you going to have in attendance? It's one thing to have an event with 100 people. It's another with 1,000. It's another with 10,000. Those are exponential increases in the attendance and likely are going to require exponential increases in the rate that you're going to pay for liability insurance. So these are just some examples of how we can standardize this. And it's nice that we have enough experience, we have enough varied types of businesses that we've got the ability to figure out what accurate rates ought to be. Nothing happens without insurance, nothing. So we've got enough knowledge to be able to tell us, well, this is what the losses are going to look like for this type of situation. And it's a matter of standardizing and classifying into a way that makes sense. So at least it sounds like there's some rules that we can deal with. And then once we figured out a rate, what changes that rate? Well, higher limits change the rate. If we're providing coverage that you don't need, you'll get a credit on your premium because the liability coverage is fairly broad. We'll have deductible credits. So if you take a higher deductible, and a lot of times we'll call it a retention level. Big business, right? They're not worried about contracts with a $500 deductible. They're going to say, look, we can pay for losses as long as the total of those losses is not bigger than $5 million. Okay, we're going to retain the first $5 million layer. And then above that, we're going to insure, well, if you can take that kind of a deductible, that's really going to decrease your premium. And so that's going to have an impact. And the way it'll be applied is on the rate itself. And then to use claims made instead of occurrence, we use different rates there too, because you're going to have fewer claims, right? Occurrence says they don't care how long it takes to file the actual claim. We've got asbestos claims that came from the 1960s that got paid. In the book, they're talking about an example of one insurance company under two policies. They got $20,000 in premium in like 1962. And they ended up paying a couple $2 billion in claims because of asbestos from those policies 45 years later. And so that was an occurrence policy that can happen. Claims made policy, that doesn't happen, right? Because the claim wasn't made by the end of 1962. And even if they took that extended reporting period, the claims didn't start to show up until the 80s or 90s. Asbestos was a huge problem for insurance companies because of what we call long tails on liability lines. And even a simple thing can take a year or two to actually clear out. That's why the claims made policy is not very popular. People want the occurrence policy so that the delay in filing the claim doesn't void the coverage. And that's generally what you see. But if you're willing to take a claims made policy, which as long as you stay with the same company for a very long period of time, isn't that much different. If you're willing to take claims made, your premium will drop. And that's why. Okay, that's enough for CGL Part 2. Make sure you're reading the book for these things and following along, because there's a lot of detail that I didn't go into. And those are things that the industry does expect you to know if you're going to end up getting credit for this course towards an exam. And that's what I want for everybody to be able to earn. So please just do your part. So far, everything looks good from what I'm seeing. So keep up the good work. That's the message. Thanks a lot, you guys. That'll be it for CGL Part 2 for lectures.